Good morning. It's Wednesday, the 8th of January, and this is Govindraj Ethiraj, headquartered and broadcasting as well as streaming from Mumbai, India's financial capital. And the top stories and themes for the day: the markets take a fresh pause on selling and rise on Tuesday. GDP growth slows according to advanced estimates. The rupee recovers and rises on Tuesday. Car sales and their surprising fall. Microsoft is to invest $3 billion in data infrastructure in India. And finally, overall tax collections are likely to fall, and we have equity markets to thank for that.
This is the Core Report with Govindraj Ethiraj.
The markets take a pause. Now, India's gross domestic product or GDP numbers are said to be officially lower than what it was earlier projected. The question is, are the markets falling because they already know that, which is of course likely, or could they fall further because of the latest numbers? Well, for that, we'll have to wait till markets open today, but we will come to the latest GDP numbers shortly. Meanwhile, looking back, the markets did pause on Tuesday after diving on Monday. The 30-stock Sensex added 234 points, which is, it rose to settle at 78,199, while the NSE Nifty 50 closed at 23,707, gaining about 91.8 or 92 points. The indices did swing a fair bit during the day, as it usually happens when institutional investors come in and retail and other investors try and take up the slack. The Nifty Smallcap100 was up about 1.3%, and the Nifty Midcap Index was up about 0.9%. We've been talking about second quarter numbers showing slowing sales, particularly urban consumption, and sales of consumer products and items have slowed down. On the other hand, jewellery continues to rise. We touched upon Titan yesterday, which saw a 25% rise in sales in the third quarter, which is October to December. We're not talking about sales in revenue terms, but in absolute numbers. Now, Kalyan Jewellers, another listed company, is reporting a 41% year-on-year revenue growth, thanks again to strong festival and wedding demand. There are some interesting trends within jewellery buying, for example, studded jewellery. But gold coin sales have been strong too, up 48% for Titan, as revealed yesterday in reports, while sales of plain gold grew 24%. So all of this, of course, raises the larger question of whether the increased investment in gold is being driven as a hedge or as an investment, which is quite likely, and more because of this rather than the usual festive reasons or festival reasons, which also comes up at this time of the year. China resumes gold buying. Speaking of gold buying, China's central bank has expanded its gold reserves for the second month in December, signaling renewed appetite after temporarily pausing purchases last year as prices rose sharply, according to Bloomberg. Bullion held by the People's Bank of China, or PBOC, rose to about 73 million fine troy ounces in December, up from 72.9 million in the previous month, according to data released on Tuesday. The more significant point is that China has resumed adding to its gold reserves, and this comes after a roughly 6-month pause. The big rallies we saw last year in gold, which sent up gold prices by almost 27% eventually, including in India, where it was a little higher, made it one of the best asset classes to invest in. So the question could be, would there be a similar rise, or could there be a similar rise in gold prices this year? Well, global central bank buying is one trigger, as we saw last year. Domestic demand for various reasons is strong too, as we just discussed. And of course, other asset classes like equities are not right now being projected to grow much, or at least be muted. So Bloomberg says that the China purchase demonstrates that the People's Bank of China is still keen to diversify its reserves, even with gold at historically expensive levels. The rupee rises. It is a relief, though I'm not sure to who all, to occasionally report that the rupee has not hit another all-time low. This time, it's logged its biggest one-day gain in more than a month on Tuesday, as the dollar dipped towards a one-week low, boosting regional currencies, while foreign bank dollar sales also helped, according to Reuters. The rupee closed up slightly at 85 rupees 71 paise against the US dollar, its strongest daily gain since late November. The dollar index, meanwhile, fell slightly to 107.9, while other Asian currencies rose between 0.2 and 0.9%. So traders are speculating if incoming US President Donald Trump may not slap as high a tariff or tariffs on all imports, including higher ones on countries like China, Mexico, and Canada as he originally threatened, which means that tariffs could be lower or more selective. Now, that's also a matter of speculation because there are denials accompanying these statements. The dollar, of course, has been rallying continuously for nearly 3 months, said Reuters, adding that the relief for the rupee is likely to be temporary amidst growing anticipation of weakness amongst speculators and hedgers. Traders are also watching to see if there are more passive inflows into index-eligible government bonds. India's GDP is now officially slowing. India's gross domestic product estimates for financial year 24-25 have now been maintained at 6.4%, according to the Ministry of Statistics of the Government of India. Now, this is, of course, lower than the 8.2% GDP growth reported in the previous financial year, that's 23-24. A formal government release said that despite a dull first half of 24-25, they expected an uptick in agriculture and industrial activity, along with resilient rural demand in the second half, and all of this could keep India on the growth path towards achieving a 6.4 to 6.8% expansion by the end of the financial year. Real GDP is estimated to grow by 6.4% in 24-25 as compared to the growth rate of 8.2% in the provisional estimate of GDP for 23-24 is what the release said. So agriculture is the savior because the agriculture and allied sector has shown a significant improvement with real gross value added growth estimated at 3.8% this year. That's 24-25, which is a sharp increase from last year's 1.4%. Other sectors expected to grow are financial, real estate, and professional services. The real estate and financial obviously is not a surprise to you. The construction sector's real gross value added is expected to grow by 8.6%. CRISIL Ratings Chief Economist DK Joshi said the decline in government capital expenditure, a key driver of post-pandemic recovery during the second quarter, is unlikely to be compensated for in the rest of the fiscal. I reached out to him and I began by asking him whether the numbers at this point were any surprise.
Well, not really, because I think after the second quarter GDP came in at 5.4%, I think immediately following that, a lot of professional forecasts cut their numbers down. Even RBI cut its forecast from 7.2% to 6.6%. Actually, it has come in even below that. Gradual slowdown was expected, but it turned out to be sharper than expected earlier because of the second quarter surprise. But overall, this wasn't a surprise.
Right. And if you were to go a little deeper, one of the things that seems to be standing out is that agricultural growth has done better or doing better, and some parts of industrial growth. So therefore, what's slowing down?
Well, agriculture did well because last year, I think agriculture did not do well. So the base effect is playing out. Actually, agriculture should have grown even faster, I think, if the monsoons and the weather had been perfectly normal. This slowdown is in investments. So we all know that investments are being led by government investments and also by household investments. We don't have the details, but we know that the government investment did slow down in the first half of the year. And I think that it's not easy to make up for that in the second half completely. Investments will pick up, but they won't make up. So compared to the budget, you are going to end up with lower investments in this fiscal year. And since that was the important driver, so that also is behind the slowdown. The other factors like interest rate hike eating into some part of the demand in urban areas, high inflation leading to some consumption slowdown in some categories, I think all that was on expected lines. But the sharper slowdown largely due to investment slowdown.
Right. And on the other hand, you've also pointed out that private consumption has done well. And this, of course, seems to be unlike previous quarters and year.
Yes, I think private consumption has grown at 7.3%, which is above the GDP rate of growth, which is 6.4. But if you look at what happened last year, I think the base effects become an important driver of activity at times. Just as higher than trend rate of growth in overall GDP last year is also a factor which led to slowdown because you can't maintain that high rate of growth. And similarly, last year, we saw private consumption growth at only 4%. So over that, I think part of it is the base effect and part of it is the revival of rural consumption. I think both of them have led to higher private consumption growth, which is about 60% of the GDP. So I think part of the rebound in consumption is the base effect. I think that's the point I wanted to highlight. That is why it has grown faster than GDP. So if you look at investment, which was the driver of growth until now, it has grown as fast as the GDP. Private consumption has grown faster than the GDP.
But that in
Which-
turn has been driven by rural consumption rather than urban, which continues to be muted.
Rural consumption and base effect.
And urban consumption continues to be slow or muted.
Relatively slower. I mean, those are the indicators because even the RBI survey tells us that the consumer confidence is a little muted, and they measure consumer confidence only for urban areas.
Right. Slightly larger question, when we say that GDP slows down, in this case, let's say from an anticipated 7.5% to 6.5% or thereabouts, what does that mean tangibly? Or what could it mean tangibly?
Well, I think I won't call it a slowdown, a sharp slowdown at all. I mean, this is just a moderation in growth to the trend levels, I think, which is our trend is, I think, we estimate the trend or the potential at around 6.7%. So from above trend, it has come back to closer to the trend this year. I think that's how I would interpret it. And also, I think while interpreting these numbers, one should remember that these are the first advanced estimates. I think they are made available particularly for helping in the budgetary process. And they only account for 3/4 of the data that is available. So if the fourth quarter surprises either way, the numbers can change. So I think one needs to keep that also in mind. Although I think we'll need to see how the second advance estimates, which will come out in February, but one needs to keep this perspective in mind. I think these are based on partial information.
Nevertheless, I mean, we're not saying it's a sharp slowdown, but if from a projection of 7.5, it becomes 6.5, something changes in the economy, right? Or something that...
Yeah, investment slowed down. So I think that is the whole point. I think the private investments are still tepid and the government investment slowed down faster than I think we were expecting. So I think that is the lesson from this for the forthcoming budget would be that I think we need to maintain the thrust on public investments even in the coming budget because it's playing an important role. The spending from the government on infrastructure has higher multiplier effects. It is also helping you over time to bridge the infrastructure gap that we have in the economy. So that is the lesson that I will draw, that overall investment slowdown is because of public investment, and since private investment is not forthcoming the way it should, given the conditions, it's important for the government to keep the pedal pressed on the public expenditure. And I think slightly good news is that private consumption has somewhat revived. I think I'm not talking about the distribution, but overall, I think the private consumption data shows has revised quite markedly.
Would there be any way of knowing what that private consumption is, typically or otherwise?
Not from this data. I think this data is totally aggregate. And I think so private consumption has both the services element and the goods element. It is also by different income classes. I think we only have proxy indicators for that. We don't really know how it has behaved. Except that I think auto was doing well last year. This year it is slowing down. Services consumption seems to be doing reasonably well. Services growth is also quite strong, I would say. So I think these are the broad conclusions you can draw. Very specific, detailed, I think you'll need to do more work on the information that is available, proxy information.
Right. And if you were to look at previous years and the advance estimates that are released, let's say in this case, first week of January, do they usually end up being the same? And what is the likelihood of change, if so, in any direction?
Well, I think it depends on the specific circumstances. And here, I think what can change the estimates positively is that if government investment actually picks up very swiftly in the last quarter, I think that can create an upside. If it doesn't do that, can create a downside. So that's one way of looking at it. And when the COVID happened, I think there were other factors. How would COVID play out and so on? So it actually, the point is that the more reliable estimate will not even be the second advance estimates, but one that comes after that. So I think sometimes you find that there's not much change, but sometimes there is change also. So I think it depends on specific circumstances. This year, I don't expect much change. I mean, so if you were to ask my opinion, I would expect GDP growth around 6.5%, I think.
Right. DK, thank you so much for joining me.
Thank you very much for having me.
Car sales show a surprising drop. Sales numbers from car dealerships across India were down a surprising 2% in December. Now, this is despite the year-end discounts, which were pretty high. but they seem to have helped only some dealerships, or from the other side, only some consumers appear to have taken that advantage. Sales dropped to about 293,000 units from about 299,000 units last year, according to data from the Federation of Automobile Dealers Association, or FADA. At the start of December, about 80% of FADA members had said in an online survey they expected sales to be flat to higher for the month, recovering from a 14% drop in November. This is something that we had gleaned too in our conversations with FADA senior members last month. However, demand did fail to pick up in the final week of the month, which usually accounts for about 30 to 40% of a dealership's sales, FADA's president C.S. Vigneshwar told Reuters. He also said that while some dealers benefited from year-end schemes and expanded product ranges, overall demand remained subdued. The other problem is that while dealers have struggled with slow growth in most parts of 2024, manufacturers have continued to produce cars and dump them, in a manner of speaking, on the dealerships. According to FADA, inventory levels are now down to about 55 to 60 days for December from about 65 to 68 days in November as manufacturers reduced dispatches. In earlier months, inventory levels had touched or rather crossed 80 days, and that was obviously a near critical situation. However, this level, that's 55 to 60 days, is still higher compared to what dealers want, which is about 21 days. Microsoft to invest $3 billion in India. Microsoft will invest about $3 billion to expand capacity for artificial intelligence and its Azure cloud computing services in India, Satya Nadella, the CEO, said on Tuesday. Reuters says that executives ranging from NVIDIA chief Jensen Huang to Meta chief AI scientist Yann LeCun have visited India in recent months. And Microsoft, by the way, is planning to invest about $80 billion in 2025 on developing data centers to train artificial intelligence models and deploy AI and cloud-based applications, the company said in a blog post on Friday. Investment in AI has obviously jumped since OpenAI launched ChatGPT in 2022 as more and more companies integrate AI intelligence into their products and services and into products that we consume, including Google search and the like. Tax collections could be down, and we may have the stock markets to thank. A report from HSBC says that the current year, that's 24-25, started off with expectations of strong growth in tax revenues. And indeed, by the end of the first quarter, tax revenues were growing 24% year on year and year to date. The worry, if any, was that spending would be high in an election year, leading to a slippage in the fiscal deficit target, which was budgeted at about 4.9% of GDP for the current year. But the HSBC report says that the tables have turned since. Tax revenue growth has softened to about 11% year on year and year to date in November, which is the tax revenue growth budgeted for the current year, which leaves no space for maneuver. But more significantly, the report says that the fall in equity markets have started to hurt capital gains tax revenues, and their back of the envelope calculations show that a third of the rise in the tax GDP ratio in the previous year had been related to equity market gains. HSBC says that they still believe the 4.9% of GDP fiscal deficit target would be achieved, rather because expenditure remains rather weak as opposed to income growing. Current spending is still strong, it says, but capex remains a laggard. Now, this is something we discussed with well-known tax expert and Dhruva Advisors founder Dinesh Kanabar 2 weeks ago. And the question that I posed to him was precisely this, which is that why were direct tax collections rising at that level? And this is what he said.
Two broad things which come up for 2024. One is we have seen a record number of IPOs. And when you see record number of IPOs, not all of them are primary, many of them are also secondary. And therefore, if I may say so, the record collections, direct tax collections, are primarily as a result of some of those restructuring which has happened, money coming to the company, investors or other promoters selling their shares. Another is, of course, the stock market boom and the money which people have made there. As you rightly observed, if one looks at basically corporate tax, the profits have been quite muted and they themselves do not warrant a 20% increase, which is what we are seeing. But it's largely capital gains. It's largely everything happening on capital market side, IPOs. So that's one part. If I look at 2024 and directionally, I think 2-3 things stood out. First and foremost, whole thing in the budget where they scrapped the angel tax. And I think that was one of the best moves that the government could do. It took number of years for that to happen, fair enough. You don't know, and I can't tell you how many transactions which otherwise were getting stalled only because of this perception that will your valuation be accepted, not accepted, and finally the government said, okay, it doesn't matter. So that has been one very significant thing. The other thing, Govindraj, which has happened in 2024 is that the Supreme Court has passed judgments in favor of the revenue, and ostensibly some of them otherwise do not seem to make logical or legal sense. But it is only, so for example, there was this whole issue as to when could or up to what period of time could the government reopen assessments when the period was brought down. So when was the past law applicable, when is the current law applicable? And if you would have gone to any legal counsel, not necessarily taking a view only for the SSEs, but the general reading seemed to suggest that old matters can't be revived, etc., etc. And the government issued some 19,000 notices. And the Supreme Court came back to say that we cannot pass an order which negates all of this, so all of this is legal. So one is seeing a trend where the Supreme Court is going on to say that we cannot frustrate the revenue in its efforts to try and collect taxes.
That was the Core Report with me, Govindraj Ethiraj. Do stay connected with more of our coverage at the Core. You can check out our website or sign up to our newsletter for our exclusive stories, one in-depth feature a day on www.thecore.in. Do also track us on LinkedIn, where we usually post synopses or extracts of our top stories and interviews. We would love your feedback on how we can make business more interesting and relevant, including, of course, India's vibrant manufacturing sector. So write to us at feedback@thecore.in. And thank you once again for listening.